Welcome to the Deep Dive. We take complex reports, dig in, and pull out what you really need to know. Today, it's Enphase Energy, ticker ENPH, and their Q2 2025 earnings. Now, earnings reports, they can be pretty dense. Our mission here is to cut through that. We'll use a 5-part framework to get the key insights. We're looking at how Enphase's actual numbers line up with, what the market expected and what it all means bigger picture.
Exactly. And it's crucial, especially in a fast-moving market like this, to look beyond just the headlines. This deep dive is not just about the what's, it's about the why it matters, helps you understand the real story.
All right, let's jump right in then. Now for slide 1, the at-a-glance scorecard. Okay, so this first part, think of it as the quick summary. Enphase headline numbers for Q2 25, how they stacked up against Wall Street, and importantly, how the market reacted right away. And here's the interesting thing, the sort of paradox. Enphase actually beat the forecasts, revenue, EPS, both better than expected, yet the stock price went down. That feels counterintuitive, right? What's going on there?
Yeah, it often does feel that way. But this is a classic case, especially with growth stocks, where guidance is king. The drop in the stock price, even with those good Q2 numbers, was almost entirely down to what the company said about the next quarter, Q3. That forward look, that guidance, it just overshadowed the solid performance they just reported.
Yeah.
It tells you a lot about investor focus.
Right, future versus past performance. Okay, so let's get specific. The numbers. Revenue came in at $363.2 million. That was a beat, yeah. Consensus was $361.9 million.
Slight beat.
And non-GAAP diluted EPS, earnings per share, that was 69 cents. The estimate was 62 cents. So a clearer beat there.
Definitely a solid beat on EPS.
But, like we said, the stock dropped about 3% right after the news hit. And you mentioned analyst sentiment turned negative because of that weak Q3 guidance.
Precisely. That weaker outlook just sort of soured the initial reaction despite the Q2 beats.
Okay, now let's look at the core performance, GAAP basis this time, comparing this Q2 to Q2 last year, 2024. Total revenue, $363.2 million this year versus $303.5 million last year. That's up almost 20% year over year. Pretty solid.
Decent top-line growth, yeah.
But look at net income. GAAP net income, $37.1 million this year. Last year, only $10.8 million. That's a jump of, what, over 240%?
Huge jump.
And diluted EPS followed, up 250% year over year. So the big divergence here is obvious. EPS grew way, way faster than revenue. How does that happen?
Right. So two main things driving that. First, it's operating leverage. Think about it. Enphase has fixed costs, right, like R&D, admin stuff. Once revenue covers those fixed costs, each extra dollar of sales contributes much more significantly to the bottom line, to profit. In Q2, that roughly $60 million increase in revenue year over year, it led to a $35.2 million increase in GAAP operating income. That's massive leverage.
Okay, so the business model is scaling efficiently. What's the second factor?
The second one is the impact of share buybacks. Enphase bought back shares. They spent $30 million buying back over 700,000 shares this quarter. When you reduce the number of shares outstanding, the total net income gets spread over fewer shares. So mechanically, EPS goes up.
Ah, okay. Fewer slices of the same pie means bigger slices.
Exactly. It directly boosts that per share number. And just quickly on basic versus diluted EPS, basic is just net income over the basic share count. Diluted is more conservative. It includes potential shares from things like stock options or convertible debt. For tech companies with stock comp, diluted is usually the one to watch.
Got it. That buyback impact is easy to miss if you're just looking at net income. Moving to slide 2, the engine of profitability. All right, next up, let's dig into the quality of those profits. We're looking at gross and operating margins. And something that really stands out here is how much government incentives are playing a role.
Oh, absolutely. Let's look at gross margin first, and specifically the impact of the Inflation Reduction Act, the IRA, in the U.S. So GAAP gross margin went up year over year, 46.9% from 45.2%. Non-GAAP gross margin also up 48.6% from 47.1%. Looks good on the surface.
Oh.
But this is a big, but that headline non-GAAP number, the 48.6%, it includes a very significant benefit from the IRA tax credits for manufacturing in the U.S.
Yeah.
If you strip out that net IRA benefit, the non-GAAP gross margin was actually 37.2%.
Wow. So the IRA added, what is it, over 11 percentage points?
11.4 percentage points, yeah. It's huge. And the implication there is, while it's great for the bottom line right now, that portion of the margin comes from government policy. Policies can change, right? So it's potentially less stable, more subject to political risk than margin improvements coming from, say, better efficiency or technology.
That's a really critical distinction. Quality of margin, not just the number. Okay, but what about operating margin then? You mentioned operating leverage before. Did that show up here?
It certainly did. GAAP operating margin expanded dramatically from just 0.6% in Q2 last year to 10.2% this quarter.
Huge jump.
And non-GAAP operating margin
Wow.
also saw a strong expansion, up to 27.2% from 20.1% last year. It really underlines that they manage their operating expenses well relative to that revenue growth, scaling effectively.
Okay, makes sense. But I also noticed a pretty big gap between GAAP net income and non-GAAP net income. GAAP was $37.1 million. Non-GAAP was almost $90 million. What's the main adjustment bridging that gap? What should listeners really focus on there?
Yeah, that's a common point of confusion. The biggest single adjustment, typically for tech companies like Enphase, is stock-based compensation. In Q2, that was $53.8 million. Now, it's non-cash, meaning physical money isn't going out the door for this expense.
Right.
But it's absolutely a real cost to shareholders through dilution. Employees get equity, the share count potentially goes up over time. There are other adjustments too, like amortization from acquisitions, some restructuring costs.
Right.
But stock comp is usually the big one to understand. You really need to look at both GAAP and non-GAAP to get the full picture.
Got it. Both perspectives matter. Proceeding to slide 3, the engine room business performance. All right, let's shift gears now to the actual business operations. What's driving things day to day? Since Enphase doesn't report formal segments, we have to piece it together from their commentary on geography and product lines. And geographically, it really seems like a tale of two continents this quarter. Europe versus the US. Europe was clearly the star. Revenue up about 11% just from Q1. They said higher microinverter and battery sales, plus the new IQ Battery 5P ramped up well there.
Europe showing good momentum.
But then the United States, much more muted. Only a 3% sequential increase in revenue. They mentioned seasonality, okay, but they also specifically called out lower safe harbor revenue. What's the significance of that?
Yes, the safe harbor mention. That's quite telling. Safe harbor rules often let solar developers lock in benefits or incentives before they expire. It can pull demand forward artificially.
Okay.
So if safe harbor revenue is lower, it suggests that artificial boost is fading. It implies the underlying organic demand in the U.S. might be a bit softer than that 3% growth number suggests on its own. This context helps explain why management might be cautious about Q3. It's not just general seasonality, it's this specific factor potentially winding down.
That makes a lot of sense. It's peeling back a layer. Okay, what about products and shipments?
They shipped about 1.53 million microinverters in total.
And a key detail there, 1.41 million of those were made in their U.S. facilities. That's important for the IRA credits, right?
Exactly. That domestic production is what triggers those valuable tax credits that juice up the gross margin we talked about earlier.
And batteries. Energy storage.
Strong quarter there, too. Shipped a record amount, 190.9 megawatt-hours of their IQ batteries. That's up nicely from Q1. It shows they're making good progress diversifying beyond just the microinverters. Storage is a key growth area.
Good to see. Are they launching new things too?
Yep, innovation continues. They started shipping their 4th-gen Enphase Energy system in the U.S., and in Europe they launched something called the IQ Balcony Solar Kit, which sounds like it's aimed at making small-scale solar easier to install, maybe tapping into new customer segments.
Interesting. Expanding the market reach. Looking at slide 4, financial strength and shareholder rewards. Okay, slide 4. Let's look at the financial foundation. How healthy is the balance sheet? Can they fund what they need to do?
Overall, pretty healthy. They ended Q2 with a very strong liquidity position, $1.53 billion in cash, cash equivalents, and marketable securities. That's a lot of financial flexibility.
Definitely a good cushion. What about debt?
They have about $1.2 billion in total liabilities, against roughly $880 million in equity, so the debt-to-equity ratio is around 1.37. A significant chunk of that debt is convertible notes, which is pretty common for growth companies. And importantly, that huge cash balance provides very comfortable coverage for their debt obligations. Leverage seems manageable.
Okay, solid footing there. Now, cash flow. This is always important. How much cash did they actually generate?
Generated $18.4 million in free cash flow. That's calculated as cash flow from operations, which was $26.6 million, minus their capital expenditures of $8.2 million.
$18.4 million. But wait, didn't you say non-GAAP net income was much higher, like $90 million? Why the big difference?
Excellent point. Yes, free cash flow was notably lower than non-GAAP net income this quarter. That signals that their conversion of profit into actual cash wasn't as efficient in Q2. Looking deeper into the cash flow statement, you see significant cash was used up by changes in working capital, specifically a $64 million use for prepaid expenses and other assets, and about $51 million related to deferred revenues. Basically means some of the profit earned wasn't immediately turned into cash in the bank. It might be tied up in inventory buildup or prepayments or how revenue is recognized over time. It's something investors should keep an eye on.
Right. Profit is one thing, cash in the bank is another. Good flag. And finally on the slide, returning capital, share buybacks.
Yes, they continue their buyback program. Spent another $30 million repurchasing just over 700,000 shares. Like we discussed earlier, this does two things. Directly returns capital to shareholders, and it also acts as a signal for management. It suggests they believe their stock is undervalued, especially, given the negative reaction to the guidance. A vote of confidence, if you will.
Makes sense. Sends a message. Finally, slide 5. The road ahead management's outlook and key takeaways. All right, last section, let's bring it all together. This is about the future management's guidance for Q3, which, as we've established, was the real kicker for the stock reaction.
Exactly. This was the heart of the market's negative response. The outlook for Q3 2025 signaled a sequential slowdown. Their revenue guidance, the midpoint, was $350 million. Wall Street was expecting closer to $368.4 million. So a clear miss versus expectations.
Okay, so lower revenue expected. What about margins?
Also guided lower. Let's compare Q2 actuals to the Q3 midpoint guidance. Revenue, as we said, down about 3.6% sequentially, $363 to $350. Non-GAAP gross margin guided down from 48.6% in Q2 to 44.5% in Q3. That's a drop of over 4 percentage points.
Ouch.
And importantly, even the non-GAAP growth margin, excluding the IRA benefit, is guided down from 37.2% in Q2 to 34.5% in Q3. So it wasn't just the IRA impact changing. The underlying margin is expected to compress too. That combination, lower revenue guidance and lower underlying margin guidance, sent a pretty clear signal to investors about near-term business pressure.
Yeah, you can see why the market reacted the way it did. Okay, so let's summarize the big takeaways from this whole quarter. First, you said it before. Guidance is king. Especially for growth stocks, the future outlook dominates. The 3% stock drop despite the Q2 beat, that was all about the cautious Q3 forecast.
Absolutely. Textbook example.
Second takeaway, margin quality over quantity. The market wasn't fooled by the high headline gross margin inflated by the IRA, that guided decline in the underlying ex-IRA margin. That clearly spooked investors.
Right. They looked through the headline number to the core profitability trend.
Third, a tale of two continents seems apt. Momentum is clearly shifting. Strong Europe, softer U.S., possibly linked to that fading safe harbor effect. Geographic diversification is key here.
Definitely highlights the importance of their European operations right now.
And finally, financial strength as a safety net. Despite the cautious outlook, that strong balance sheet, the $1.5 billion in liquidity, the buybacks, it provides stability and options.
It's a crucial buffer. It gives them room to navigate potential headwinds. So, summing it all up, Q2 for Enphase was really a classic beat and lower scenario. They executed well in the quarter just passed, benefited significantly from the IRA, beat expectations, but then they delivered a cautious forecast for the next quarter, signaling slower growth and some margin pressure. The market reacted swiftly to that forward look, essentially repricing the stock based on those moderated near-term prospects. And hopefully walking through it like this, using this framework, helps everyone see beyond just the initial headlines and understand those underlying dynamics.
Absolutely connects the dots. So maybe a final thought for our listeners to ponder. What does this whole Enphase situation tell us about how the market weighs past results against future promises, especially when government incentives are such a big piece of the current profit picture? Something to think about. Okay, just the usual quick reminders here. This deep dive is purely for informational purposes. It's not financial advice. Please always do your own research. This analysis was generated by AI. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.